Is this really it for Bill Gross?
Well, depends on your definition of it, I guess, as to paraphrase Clinton. But it's it from the standpoint of managing institutional money. You know, I have a large amount of family office funds, quote unquote, and foundation funds of my own. So lots to do in terms of investing, but in terms of earning fees and managing institutions, yeah, that's it.
You really are calling it quits after almost 50 years of professional investing for others.
Well, yes, and you know, I find, and the question might be why. That's what you're implying or begging.
We can get to that answer as quickly or slowly as you like.
You know, I just thought it was time. We talked about your dad over coffee, and I gave you the Babe Ruth story about as days and years go by, it's time to step aside and let the younger folks take over. But in addition to that, for me, it you know, it was a situation where I just wanted to be able to relax a little. You know, aside from the unproductive trades in the last few years, I would check Germany and Japan twice a night, usually at 12:30 and sometimes at 3:30, then up at 5:30. You know, in addition to that time situation and lack of sleep situation, it for me, and I think probably for many portfolio managers, I always felt such a personal responsibility to what I was doing, and you know, ultimately, it got to be hard when the numbers, you know, got to be low, and so I said, you know, perhaps it's time to give myself a break and give my clients a break.
What will you miss?
Oh, I think I'll miss, you know, just the constant activity, the almost minute to minute, which belies really my long-term philosophy of a secular type of outlook. But you know, within the context of a secular outlook, managing portfolios was always for me minute to minute and day to day, and exciting from the standpoint of prices moving and hopefully moving your way. And so I'll miss that. It was like a drug, a drug sort of like an endorphin after you work out, that when you come in and you're doing well, you feel great. Problem being that when you don't do well, you feel depressed. But that, you know, that's the part of any portfolio manager's job. I just think at 74, it got to be, you know, a relatively heavy weight on my shoulders.
Withdrawal can't be an appealing prospect. Even those addicts who go from heroin to methadone find it tough. What do you think it's going to be like?
Well, you know, I've always been, and one of the reasons I think I've been good at what I've been doing is that I've always been able to look ahead and to see where people go, and assuming that I'm in the same category, that I would follow. You know, you see that in literature, and you see it in you know, current magazines and so on. You know the history of life from the standpoint of professional activity, and certainly in my profession. And so I knew, and I was sort of expecting it at a certain point, even at PIMCO. You know, when Bill Thompson and I brought in Muhammad, gosh, in 2009 or 8, I forget. But we were planning for our succession. Wasn't really ready, but...
But it was already a subject under discussion at that point.
Sure, and in my mind as well. You know, people would say, and with some justification, why are you doing this? You know, you should be on the golf course. And I go, well, I sort of like it better here than on the golf course. So it was a personal preference, but there's a time and place, and I just thought that now was the best time for me.
I'm sure you remember, Bill, the conversation we had here in Newport Beach. It was almost 4 years ago, and after what I might describe as something of a bruising battle with PIMCO, I asked you why you hadn't retired then instead of starting a second act at Janus. And I don't know if you remember what you told me then, but you said you needed to prove something to yourself, that quote unquote, I still got it.
Right.
What changed your mind?
Well, it's 4 years down the road. And to be fair, the public numbers in terms of the unconstrained funds were not spectacular. As a matter of fact, that's an overstatement. They were not good, although positive. I think, just in my defense, I managed a few total return accounts, just like the PIMCO Total Return Fund, not public, institutional, and beat the index by 100 basis points a year, just like I did over there. So, so if in that case I proved it, the follow-up question might be, so why didn't you prove it in the unconstrained universe? And I think there's an explanation for that that I could give you if you'd like to hear it.
Sure, let's have it.
That's why you're here. Well, unconstrained is different than total return. It sort of implies a freer universe and to some extent more risk-taking. Some clients assume it's a hedgy type of portfolio, and some think just the reverse, that it's more money market type of return. But it got to a point where interest rates were so low, and if you weren't managing it with a significant duration or a relatively high amount of risk, it was a 1 or 2% type of return. And so
and that, in your mind, wasn't enough?
In my mind, that wasn't enough. I thought my clients wanted more. And so I became a little less constrained, which in looking back and self-criticism was probably always something at PIMCO that was very much of a positive, to be constrained, to
have those guardrails,
to be a measured risk taker, which I always said I was, and so I became a risk taker, but not necessarily measured, and ran afoul of my old blackjack maxim that said you can never bet more than 2% of your stake, meaning in this case every trade should be 2% of the portfolio. Yeah, I wanted more. I stretched, and obviously
you took another card at 17.
Yeah, sure that the dealer had 20, so I had to go get it. But yeah, so that, I think that's a self-criticism. It's not that I slowed down or lost any brain cells or any enthusiasm for what I was doing. I still, like I just talked about, was still getting up in the middle of the night and still worrying about clients and perception and all of that, which has driven me for 50 years. But yeah, I made a mistake there.
Do you think it's fair to say most people don't appreciate the difference between the nature of a total return strategy, generating alpha, beating a benchmark, and the nature of an unconstrained strategy, effectively beating cash?
Yeah, no, I think so. Especially with the unconstrained category being so amorphous and little defined, where, as I suggested, some think it's really a hedge fund where it was necessary to generate double-digit types of returns. And so I didn't do well in the unconstrained universe. For me, I'm obsessively focused on taking moderate risk. The total return fund at PIMCO was always that. It was never super long duration or super short duration, et cetera, et cetera, et cetera. And it was adding alpha at the edges in many areas, and but it was constrained first by client guidelines and regulations, and second,
which you and your sales team helped to push.
exactly, and that's how I grew up. That's where I learned my lessons, so to speak, in the Vegas casinos, where you just couldn't put it all out there on the table. You had to do it at the edge, and so I think that was really my universe. And like I said, I'll beat this for the third time. I did well here in total return, but not in unconstrained.
Why is it harder to beat a risk-free bogey that always trades at par?
Well, first of all, because the risk-free bogey for the last 4 or 5 years, now it's better because of what the Fed's done, but it was averaging 1 to 2%, and with fees at 75 basis points, you feel for the client. You're getting as much as they're getting, and so it doesn't become incumbent, but I was moved in a direction that said they certainly need more than Janus needs, and so I should move the risk edges further out in the universe.
Do you think, in retrospect, you underestimated the change in mindset and approach it required?
No, I think I made some bad trades.
It's as simple as that.
I made some bad trades, but they were risky trades from the standpoint of their percentage position within the portfolio. To me, they were a slam dunk, and I think they still are slam dunk long term. But as portfolio managers and clients know, the short term within the context of the long term becomes very important. I'm talking about a year or 2 years or 3 years, and if after 3 years they don't see any numbers, they figure they won't see numbers for the next 3 years. So that became part of the problem.
If you're confident that some of these trades will prove to be profitable, why leave now?
Well, because as I've suggested, that it's a very personal thing with me. And I know this sounds a little cloying, but I always thought of the client first. When I got up in the middle of the night to check Germany, it was always how much are my clients making or losing, and so it became harder and harder to shoulder, I guess. And I thought, even though these were good trades and would probably work out, I just thought it was time to play more golf. And
was it all you, or did you feel any pressure from, could be Dick Weil, or anybody else at Janus Henderson?
No, never. I mean, Dick was always supportive. Sometimes not so on TV, but he was always supportive to me, and I think he truly felt I was always the best bond investor in the world, and he always told me that I had a home here as long as I wanted it. So, no.
For better or for worse, Bill, we've all read and heard things about your personal life. Were you able to compartmentalize all of that, or did it distract from your focus?
I think so, but you never know. I mean, my personality, not to get personal, I'm an Asperger, and Aspergers can compartmentalize. They can operate in different universes without the other universes affecting them as much. And so, yeah, I had a nasty divorce, and I still had, feelings about PIMCO, but I think it did pretty well in compartmentalizing them. Not that I didn't wake up in the middle of the night and start damning one side or the other, but when I came to work, it was all business, and I don't think it affected me that much. But, it's hard to know. You are not your best witness when it comes to trying to figure out whether something is affecting you or not. And so that's a possibility.
I didn't know you have Asperger's. Is that what you meant in February of 2016? In one of your outlooks, you wrote about Michael Lewis's book and the movie it spawned, The Big Short.
Yes.
And you said that you shared an attribute, or an affliction, I think,
yes,
with one of the heroes, if you will, of that book, Michael Burry, Dr. Michael Burry, and it wasn't his glass eye.
Exactly. If you got a minute and a half, is a fascinating story. And so I read that book. And Lewis is a great writer. And within that chapter about Michael Burry, he listed 10 things that Asperger's have that Michael had as well. And I read them, and I go, and some of them were not being able to look somebody in the eye, which I'm not doing very well at the moment. Singular hobbies like stamp collecting, et cetera, et cetera, et cetera. And I go, hi, that's me. I go, and so I took the book out to my ex-wife. I said, I read this. And she read it. I think I have Asperger's. And she said, you do. Not you do, but she said, you do. I said, how would you know that? She said, well, when we were having dinner with Bill Gates and Melinda, and that was like 5 years before, at a Duke reunion fundraiser at his home, she said, we were sitting at the table, and I looked at Gates, and I looked at you, and I looked at Gates, and I looked at you. I said, you were doing exactly the same thing at the same time. Your mannerisms were all the same. And so I had heard that he had Asperger's in a mild form. So I went to a psychologist, and I described it. And the psychologist said, he has Asperger's. So I said, why didn't you tell me? And she said, because I thought it might hurt your feelings.
You didn't know this about yourself?
Until I read it in that book.
Until you were in your early 70s?
Yeah, but it explained a lot. Not that, and I'm sort of proud of it, or else I wouldn't be telling you. I'm sort of proud of it because it explains a lot about me. Not that, all Aspergers are not geniuses. Some, the intelligence thing is not necessarily a big part of it, but, my personal behavior and ability to relate to people, my singular hobbies, stamp collecting, this and this and this and this. It said, hey, so maybe I do. And so I did go to a psychiatrist, and in the first meeting, at the end of it, I just threw it. I said, do you think I have Asperger's? And she said, oh, yeah.
There is a line of thinking, I'm sure you're familiar with it, that says people with that condition, I wouldn't call it an affliction, do better as investors. Do you think that's true?
I think so.
Why?
Well, because as I've understood it, in my experience, it's allowed me to stay at 30,000 feet as opposed to be on the ground. Basically the condition is one in which I'm sort of up here, and as other people will know, when I come into a room and they say, Bill, I'll go, I'll be, I'm up here. And so that's not necessarily good in terms of one-to-one. People think you're angry or an a-hole or whatever, but it helps you to focus on longer-term things without getting mixed up in the details. And so I think it was very important because it allowed me to take what we call the secular approach at PIMCO, the long-term view, and it was a good view to take as an Asperger. Now, if I was a quantitative trader, hedge fund manager, day-to-day, minute-to-minute, boom, 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 not so good.
Interesting. Do you think it helped you identify patterns better?
Probably, but I never thought about it in those terms. But probably from the standpoint of, again, of 30,000 feet, yeah, yeah, because it allows me to just forget about minutia and to focus on one big thing, whatever it is at the moment, as opposed to 5 different things.
Now, I'm going to get a little meta on you, if I may. Second order, if you like.
Okay.
Do you think finding that out, recognizing it, and perhaps coming to terms with it on a personal level helped or hurt?
Well, I think it helped personally. Yeah, it explained a lot. Because, you know, I'm introverted, basically. I'm pretty good here. But, you know, I've always had problems in going up to somebody, saying hello. I expect them to say hello to me, not because I'm a wheel, but because I'm an Asperger. And so it explained a lot. And you know, like you say, it's a mild condition of autism, right on the border. It's nothing to be ashamed of. Like I said, I'm proud of it, and because it explained why, in part, why I was who I was. You know, not to negate my upbringing, my family background, and how I came out of the oven. We all come out of the oven with a personality, as you as a parent know. You've got 2, and I'll bet you they're different, right?
They certainly are.
So, you know, there's all of that, but yeah, I think it helped a lot and relieved a burden for me that sort of said, hey, it's not necessarily my fault. I'm trying, but I just can't compete with the extroverts like it would be nice to be able to do.
As someone who now knows about it and can look back on your career and identified what it did and didn't do for you, what would you say, Bill, to other people, younger people, who find themselves with the same condition, who are entering the financial markets as you once did? Is there any benefit of experience that you would offer them?
Well, if it was the same condition as mine, then I assume everybody's different.
Yes.
You know, Gates is, you know, I'm sure substantially different than me, if he indeed is an Asperger. I don't know. But you know, I'd say it's a positive that can be used in terms of careers to be able to look forward and to not get dragged down in the day-to-day, to have a plan, to you know, to succeed, and if you're down, you can get back up, et cetera, et cetera. But you know, I'd also say that the markets are substantially different today than they were when I started, and you know, it is more day-to-day. It is more robotic. It is more machine dominated, and so it's not a negative, but it's probably not as much of a positive, because it doesn't. It gives you time to work. You know, given market conditions, and I think today it's so staccato-like, as opposed to when I started.
That's not an understatement, right? Financial markets have changed a lot. What would you say has changed most about financial markets in the past 10 years?
Well, I think the presence of the central banks and their attitudes towards money and credit. You know, and the obvious QE and quantitative easing, the fact that many central banks still have negative interest rates, et cetera, et cetera. I mean, it's a world in which economists writing textbooks 20 or 30 years ago would not have imagined.
Trillions of dollars.
Yes, of negative.
Of securities trading at negative yields.
Who would give your money to lose money, basically, and there's an understanding as to why now, but back then it would have been ridiculous. And so I think central banks have changed the nature of the game, and Whether they continue to do that or can continue to do that, I think is a big question of the day.
There's a lot of debate over the role, the influence, and the benefit of a host of new actors in the markets. Passive vehicles, such as index funds and ETFs, momentum and trend following strategies, like CTAs or maybe risk parity funds, and of course, quants. What do you think about this debate?
Well, I think in terms of the index funds, the debate is a phony one. I mean, the real debate's about fees, because the entire market is an index, right? And even if it was all actively managed, there'd always be one side or the other at 4 times the fees. And so, the argument about ETFs and index funds, I think is a
specious one?
Yes, it is. It's really, if you're negative on index funds and ETFs, what you're really saying is we want to continue to charge 50 to 100 and 150 basis points. Bogle had it right. He had it right. Of course he had it right.
John Bogle, yes.
And, his emphasis on index was really an emphasis on low fees and low trading as well, I suppose, but really low fees because, he always felt that the investor was giving up 1 or 1.5% a year. And it was sort of easy when markets, and even bond markets, were returning 10, 12, 14% a year to forget about the 1. But when bond markets are only returning 2 or 3%, like I say, in some cases negative, you can't do that. I'm all for it. I do think, though, that you can have an actively managed ETF. I mean, at PIMCO there was BOND, and fine, but it's the fees that are the problem.
What about those other things? The momentum players, the trend followers, and of course, the quants.
Well, I think momentum has been shown over the years, and I read textbooks and followed it for years in terms of yearly reports by Standard & Poor's and Moody's. They had a wonderful yearbook every year. Momentum has been shown, to be a structural alpha generating policy. Now, why would that be? Because it basically assumes that that if you follow the crowd, you're going to do okay. Well, you do okay. It's like surfing a wave. You do well surfing the wave. It's just that when the wave starts to crash, you have to know when to kick out, and that's when momentum doesn't work. When volatility shoots higher and the VIX goes against, selling of volatility, et cetera, et cetera. But momentum basically says, hey, the crowd, and if the crowd is Fed friendly and Fed generated, then yeah, it pays to follow the Fed. It pays to follow the crowd, but you have to know when the wave is going to crash, which is the perpetual burden of a portfolio manager. So I think that's okay. And there are other structural alpha factors that here at Janus and at PIMCO, value over growth over a long period of time, high yield at the margin, double Bs versus, higher quality. And so, I think there are things to look at that still exist in the market that can generate alpha, although the probabilities of generating historical alpha in the same way are much less than they were.
So the era of outperformance isn't over? It's what?
Well, it's certainly diminished. If only because, let's take bonds. It's harder to say that the stock market is in a bear market. It's easier to say that at 0% interest rates that bonds basically can do no better. But you know, a 10-year Treasury over the past 30 years had an information ratio, or a Sharp, or to be simple, an alpha, of 30 or 40 basis points, just holding it and in a bull market and having it roll down the yield curve to a 9-year produced structural alpha. Well, 10 years don't roll down the curve anymore, and 10 years only yield 270 as opposed to 14 or 15% now. And so, you know, certainly from the standpoint of a bond investor, information ratios and Sharps and alpha generation, which in part over the past 30 years was generated simply by the market itself, okay, from no brilliance at all, whether you're at PIMCO or you were at BlackRock or wherever. Yeah, it does. The opportunities are diminished, and you would think that much of that transfers over to the equity market, but it hasn't happened yet.
What about structural inefficiencies? Many professional investors say the structural inefficiencies they used to generate alpha are themselves vastly diminished or gone altogether. Do you agree?
Well, I'm not sure which ones you're
inefficiencies in volatility markets, for example, or the basis between cash and futures and treasuries, or even something a little more abstract, like moving the guardrails around you know, what your clients are prepared to accept in a total return strategy.
Yeah, I think you know, that requires a statement that markets have gone about as far as they're going from the standpoint of technological progress or new products, which is always dangerous because there'll always be something. But let's take an example of PIMCO. One of the reasons why PIMCO did so well wasn't necessarily from the genius of Bill Gross or the investment committee or any of the other people, but it was from our recognition of new products and our willingness to jump on board the train when we had confidence that the products were creditworthy.
Like mortgages, for example?
Mortgages in the 70s. I mean, investors basically wouldn't touch them because I remember our accounting department, they didn't know how to segregate the principal and the interest. And it became, you know, there were complaints aplenty. And I said, come on, get over it, you know, because these things were so cheap. You know, we got in early. We got into financial futures very early, in the early 80s when people and clients thought that you know, treasury bonds and treasury bill futures were akin to soybeans. You know, you had to go out. Chris Dialynis and I went out with a T-shirt, said, you know, the wave of the future. But clients said, is this like soybeans, or are you trading corn? But the spreads were enormous in terms of value, and on and on and on. With TIPS and with global bonds, we got in early. You know, we just...
Adding in non-index risk.
Yes, but risk that was so attractive in terms of return, basically an arbitrage. The Treasury futures versus Treasuries was sort of a riskless arbitrage, and so we got there early, and there was a lot of alpha generated from that, not necessarily from brilliant long-term interest rate calls, which and there were some of those.
So those arbitrage opportunities are largely gone.
Yes, unless you could tell me about new products and new innovations, and I suppose, you know, the speed trading and the algos are one that I haven't really jumped on board or understood because it takes a large staff. Didn't have that here. I don't know what PIMCO is doing, but so you know, there are going to be some things where you can generate profits from new ideas and technologies, but I would think markets are highly developed from the standpoint of you know, a menu either real or derivative types of products, and we've gone about as far as we can, I think.
Bill, is there an optimal strategy in fixed income right now?
Well, let's start out with the situation as best as I can describe it. It's low yielding, higher yielding in the U.S. than elsewhere, certainly. I mean, U.S. Treasuries are 250 basis points more than German bunds, equal quality, but different central banks. But it's low yielding and therefore has a high duration, significantly high duration, and therefore a substantial amount of potential volatility. We haven't seen that because the Fed's gentle and other central banks aren't moving. But at some point, if inflation or if some type of circumstance exists, there's a lot of risk there. In the swaps market, and I know this is a little technical, but a 30-year swap yields the same as 3-month LIBOR. Now, in a swap, you basically receive the 30-year swap at 270 and you pay LIBOR at 270, so it's the same. So you're taking a 25-year duration risk for the same return as you are with a 3-month LIBOR. It's very risky, okay? And institutions are doing that because pension liabilities and accounting rules and so on are very risky. So to your question, is there an optimal strategy? The optimal strategy is to be very conservative and cautious from the standpoint of duration, even though there are circumstances which might allow for deflation or as opposed to inflation. But clearly it's like I guess the Super Bowl where the other team's ahead by 24 points in the fourth quarter. You can do it, and I guess New England did it once or whatever. You can do it, but it's pretty long odds. So an optimal strategy would be conservative from duration, would be conservative from credit too. And I'm not talking Armageddon, but there's risk aplenty in terms of high yield bonds if we have a recession, and many economists are seeing one within the next several years, and so it pays to be conservative from that standpoint.
Do you see a recession?
I think so. I mean, we've had a good economy, not a great one, but a 3% one, a 2% one. We don't have to talk about Trump or Obama, but $1 trillion worth of deficits has been a substantial push, and economists know that eventually, that $1 trillion, usually about 12 to 18 to 24 months, it wears off. The kicker kicks, but then there's not an additional dose, so to speak, and so. Unless you can foresee a change in the global environment with an economic leader like China or to suggest the impossible Europe, the United States is going to suffer from the lack of fiscal sustainability in terms of that $1 trillion of deficit spending. And so, growth has got to come from productivity.
Not from the future.
Yes, and investment has been not as high as it should have been. So maybe not a recession. And recession's the R word. What's the difference between a 0.5% growth and a negative 0.5%? Not much, I guess, in terms of jobs, a certain number. But there's a period of low growth and maybe even recession ahead. And there's a lot of problems, as you know. Don't have to talk about them, but there's Brexit, there's China, there's trade. There's, again, the lack of an additional $1 trillion deficit on top of the one we have. And so, we'll see.
What do you think starts the next recession? What does it look like? And how do policymakers respond?
Well, we're seeing some of that in Germany, which is the leader of the EU. They've had a negative quarter, and Japan has sort of been like that for a while. I think, to my mind, it would come from China, but China's so good at covering up or masking. I've always said that China's sort of like the hot dog of the global economy. There's a lot of mystery meat inside those borders, and you never really know whether it's growing at 6 or growing at 2. In terms of a recession, you always want to look for where the debt is, because it's too much debt that begins to precipitate the waterfall that eventually turns into Niagara.
And where is that debt?
Well, it's everywhere.
Yeah.
It's everywhere. It's less.
Well, I guess what I'm asking is, what it is everywhere. Is there anything in particular that you think is most vulnerable or likely to crack?
Well, let's talk about the U.S. The U.S. household sector is actually in decent shape.
Yeah.
They've reduced their debt. Their mortgages have been paid down. Interest rates have come down. They've gained liquidity, et cetera, et cetera. Corporations have increased their debt, not to a proportion where there's a lot of risk everywhere, but stock buybacks at $1 trillion a year. That's debt. That's increased leverage. One of these days, that's going to slow down corporate earnings because they have to pay the bill.
Are you pointing a finger at triple Bs?
Oh, that's what pops up in the press because they're the closest thing to junk, right? To double Bs, and they're the ones that are most highly leveraged. I wouldn't go there. Necessarily, but in the United States, in total, we've got like 260% debt to GDP. China has about the same. Japan has much more. That's a lot of debt, and the problem becomes when the interest rate, as in Fed funds or LIBOR, goes to a certain level that where it causes debtors to be overburdened, as in the Great Recession. Example, Bernanke raised interest rates from 1% to 5.5%. I think was the peak. Under the context of 5.5% was a pretty normal rate over the last 20 years, but it wasn't relative to the leverage that existed at the time. Jim Cramer on CNBC, the famous, they know nothing. They didn't know much. They had no idea of the mortgage market. They had no idea of the LIBOR loans and the no-docs and the variable rate interest payments that started at 1% and then quickly flipped to 7 or 8%. And so the Fed has simply made a mistake in an increasingly highly leveraged world. I think those conditions still exist, and so that's why the Fed's been careful. That's why they've stopped where they've stopped in order to take a look. But the generators of credit, which are basically central banks and their banking associates, they're the ones, either because of interest rates being too high or all of a sudden, a turnaround in quantitative easing, becoming tightening, et cetera, they're the ones that can make a mistake more than anyone. So I would look in that direction.
Do you see a viable path out of money printing and perma-stimulus, or is Japan the blueprint?
And that's maybe the question of the day, of the hour. I wrote this seven years ago. I'm going to pull it from the bottom of my seat there just to read it. I thought it would be interesting. And it's your question. It says, can you solve a debt crisis with more debt? Can you? So I wrote to myself, you can if initial conditions, meaning debt levels, are not excessive, and creditors will accept repressive yields and the possibility of credit deterioration. And in the case of sovereigns, downgrades from triple to double to single, whatever. And to continue, that it keeps nominal yields below normal growth rates. If not, credit markets will delever and flee to money or money substitutes, cash, gold, hard commodities, etc. Recession and depression may then result. It's like what I've wondered in your question about Japan. I've wondered when money at negative interest rates will go to a mattress as opposed to a bank. And in the case of institutional investors, they have to basically. They can't put their money in a mattress. They have to put it on deposit with the central bank, and the central bank says minus 75 basis points, and that's what they're going to get. So they're sort of like prisoners in this particular dilemma. But individuals on the outside, mom and pop, at some point in Europe, may simply say, why would I pay somebody to take my money? Why would I not?
Of course, that's the rational response, but that's what's happening. It's the irrational response. So I guess what we're talking about is whether it can continue indefinitely.
I don't, and this has always been my answer. It can, as long as, and Japan has been very successful. I wouldn't have believed it, and others wouldn't have believed it. They would have felt that the system would break down and that inflation would be created, et cetera, et cetera. But it hasn't happened yet. But what happens and why it's so slowly negative from the standpoint of a healthy economy is that institutions like insurance companies and banks and pension funds is the best example, where pension funds assume that bonds will return 4 or 5%, and they're only returning 1 or 2%. In Germany, they're negative. But the assumption is that at some point they'll get back to that level. When they don't, then they're underfunded, and at some point down the road, they have to make up for that funding, or they have to default. And so it's a slow. This situation of negative and low interest rates is a slowly deteriorating situation from the standpoint of economies because it destroys the savings function. Okay, not just mom and pop, which they can suffer for a long time. I played golf with Charles Schwab this weekend, and my partner Amy Schwartz was sitting next door, and she says, "Hey, why can't you get my interest rate on my money market account up?" And he said he got out of it easily. He said, "Well, you have to turn to the guy on your left." But that's the ultimate question is that savers are being robbed of their just desserts relative to risk, and certainly in Europe with negative interest rates. And so it destroys the function of capitalism where risk and return should, over a long period of time, be in balance.
So the equity market vigilante hasn't put the bond market vigilante out of business permanently? Just for now?
Just for now. And I don't believe that the bond market vigilantes are no longer in charge. Let's be serious. I mean, that was 10 or 15 years ago.
No, I'm thinking more in terms of deflation versus as the fat tail risk versus inflation as the fat tail risk.
I think I don't know how to measure it, whether the scale is equal, but I do think that deflation, for a number of reasons. One, there's a lot of debt, and if interest rates do go up, the burden, the 16 tons, you're too young for Ernie Ford, and 16 tons and the burden of debt.
You got me on that one, it's true.
But anyway, as debt builds up and interest, it becomes a burden and deflationary ultimately if interest rates rise, or even if they don't. Second of all, demographics are deflationary. Okay, for the older people like myself, and even in their 60s, don't spend as much. They don't need another house. They don't need another car. They just want to. They need more health care, but that's about it. So that's, and technology is very deflationary from the standpoint of, as we know, computers, but also Amazon. Amazon's deflationary. Boom, the prices are low. So those are three substantial structural situations which aren't changing. Debt's not going to change. Demographics, we know the globe is getting older, and technology will continue. So that's deflation. The central banks are fighting it. Okay, the central banks with their quantitative easing, their low interest rates say, oh, okay, we cannot deflate because the burden of debt is too large. And if we deflate, then companies will go under, and the Great Recession will look like a little fun ride, as opposed to the world's largest roller coaster. So it's this battle between central banks and low interest rates and the deflationary forces that continue to exist. And so the question becomes, can central banks inflate? That was your question of 20 minutes ago. How do you structure a bond portfolio these days? It's a toss-up. It's that coin flip.
Let's throw fiscal policy into the mix and let me ask you about modern monetary theory.
I think in terms of monetary and fiscal policy that they're co-joined, or becoming more and more the same, one and the same. It used to be that the Fed and central banks were their own separate thing, and yes, they accommodated the Treasury by buying debt at a certain point in order to keep interest rates low. But as we've seen in Japan, basically the BOJ buys everything that the government issues. They're the same. And in the case of Europe, it's been, in the last 5 years, it's been 30 or 40% of what they issue. In the United States, it was, 20% or so for a while, no longer. So, so they're almost one and the same. So it becomes and this is almost like the South Sea bubble in a way, if you look at it this way. If the monetary and fiscal policies are together, then why can't the government have a $2 trillion deficit if the Fed is simply going to buy it, like they do in Japan? Well, Jim Grant would say,
Of course he would.
It'd be inflationary, but it hasn't. It hasn't been because of these deflationary forces. So. Yeah, I would say Trump or the next president, whoever he or she is, could go to $2 trillion as long as the Fed was willing to accommodate. And by the way, Rich Clarida, I think yesterday, maybe on Bloomberg, advanced just that theory. It would, it hasn't got many headlines, but and I like Rich. I grew up with him, or he grew up with me. Maybe that's the problem. I don't know. No, but he suggested, hey, the Fed can Fed can do just what they're doing. We can go negative. We can go back to quantitative easing. We can do this. We can do that. We can buy stocks. We can do all of these things if there's a implication of another Great Recession. And that simply meant that there's a possibility that the Fed, the central bank, the monetary entity becomes one and the same with the government. It's possible, but it can't be productive, and it can't be healthy for the economy when that happens. There has to be, in my view, an independence of those that create money and those that spend it. But increasingly, that's not becoming the case.
At the age of 74, having had the successes that you've had, having made the money that you've made, but at the same time, having been very public about your concerns over inequality, what it does to the social fabric, the challenge that it presents to government, what are your politics?
Increasingly liberal. I'm a registered Republican, and I say that just sort of as over at the country club, if you're not a registered Republican, you're out of there. But yeah, increasingly, I've recognized, at least from my viewpoint, the inequality of the rich versus the middle class versus the poor. We don't talk about the poor anymore. It's always the middle class, and the implications of that down the road. I mean, some of these things are populism is becoming more violent or more enthusiastic in other parts of the world, like France and so on. If it continues, I mean, if this Gilded Age continues, there will be implications. Whether
of what sort?
Well, and I'm not talking about revolution, but maybe revolution at the ballot box. Maybe the next time, the next election, there will be a quote-unquote socialist in the White House. That's what the Republicans would call them. I would say they're just liberal Democrats. But I think the wealthy have been advantaged for a long time, and certainly in the past few years with the tax cuts. And the middle class has not necessarily suffered, but certainly the gap has increased. And the relative gap is important. I mean, people can have a nice house, but if their neighbor has a house that's twice as nice, they're upset. And what do they do about it? Well, they don't necessarily try and burn the neighbor's house down, but they complain about the trees, or they complain about the yard, and at some point, the owner of the nice house starts to feel it. So I'm just saying, I mean, that's the political future that I sense is coming.
Do I dare ask you if you sympathize with the so-called democratic socialists, the likes of Alexandria Ocasio-Cortez?
Well, I think she's a fresh face, and I like her courage. It obviously is at the edge, and I'm more inclined to think about healthcare from the standpoint of increasing the universe of population to receive it, either through Medicaid or Medicare or whatever. And I think a commonsensical observer would have to know that you don't go socialist from the standpoint of healthcare overnight. It takes a long, long time. But yeah, I think healthcare has to be a critical question, and it's something where the disadvantaged relative to the advantaged begin to understand that they're getting a short stick, and they will make that known at the ballot box.
So you admire her courage. Do you admire her ideas about healthcare or beyond? Do you agree that, for example, taxes on the wealthy need to be higher so the government can act as more of a redistributionary actor?
I think it's a necessary evil, if you want to call it that. I think capitalism has proved to be the most successful system in the world. It's just a question of the balance. What should the tax rate be?
What should it be?
It should be higher than it is. No, it shouldn't be where it was in the Kennedy era, but it should be higher.
Even if nobody paid that rate.
Yeah, but yeah, the
70%?
No.
At the margin? No.
I'm not in that category. I just think Trump took it too far, and we need some balance. And maybe it should be in the form of a larger deficit. Maybe you don't have to increase tax rates. Maybe you can keep the engine going from the standpoint of corporations by keeping tax rates where they are. But there have to be more benefits for an increasingly disadvantaged and aging middle class, or else you see just like global warming, quote unquote. You see the opioid crisis. That's a function, I'm sure. That's a function of nothing to do, disadvantaged, no benefits. What else would an unreasonable person do but turn to drugs? They do. That happens.
It's a scary thought.
Yeah. So, a good economic system, balances benefits as well as continues to maintain incentives for people and for corporations that want to succeed and can generate productivity and technological progress. So you need that, but you also need, on the other side, you need to balance the benefits so that things don't happen. They will happen. It's just a question of time. It's just like global warming. It will happen. And they're starting to happen. California, everywhere. It's hard to deny, and it's just that some of these things are so slow that people go, and they're not necessarily being selfish, but they just think it's so far out there that their kids will take care of it. But in some cases, it's hard to take care of unless you catch it early.
Bill, even you would admit, I'm sure, that you left a big imprint on financial markets and investing. What do you want to be remembered for?
I do want to be remembered for my success and PIMCO's success, and for, as one service, Morningstar said back in 2010, for generating more money for more people than anybody in the world. I do want to be remembered for that, because people come up to me and they go, "Thank you so much. I invested in one of your funds 15 years ago, and now I can do this, and now I can do that. Thank you, thank you, thank you." So I think that's what I want to be remembered for, and I was part of the process. We don't have time to talk about all of the important pieces at PIMCO from the get-go back in the early 70s, but what I and others did at PIMCO was a wealth-creating machine for investors that wanted conservative wealth creation, and we did that. And so, I'd like to be remembered for that.
What would you say are the most important lessons you learned as an investor and as a business builder?
Two different ones. As an investor, that like Buffett, I think it's best to look long-term, secular. I mean, Buffett talks about these days about investing in he invests in companies, not in stocks. Companies, and that's good. I think an investor has to take a long-term view, not like bogle where you just forget about it and let it run, but you've got to take a longer-term view because you can get whipped in the short term. I learned early on and experienced it many times, I guess, that fear and greed, two different sides of the spectrum, can be very destructive. Fear being the situation where you sell at the bottom, and greed being where you buy at the top. So, if you can kick the emotion out of the equation by being a secular investor and knowing that there are ups and downs, I think that was always the biggest point of success from the standpoint of PIMCO, and I learned that frequently along the line. Now, from the standpoint of organization, which I was a distinct failure at, because I didn't, and I speak to PIMCO in 2014 and that situation, but I was very naive from the standpoint of organization. I mean, I wasn't the CEO. I didn't want to be the CEO. I was the CIO. I wanted to manage money and bonds. I wanted others to...
But you can't say that you didn't build or help to build a successful organization. That whole hub and spoke structure is largely your creation.
No, I think that's true, but where I was naive from the standpoint of a company and an owner, I guess, from the standpoint of Allianz. First of all, when we sold a good portion of the company to Allianz, and I knew it, but I didn't really care about it. You give up independence. I mean, we fought fiercely for independence. We always thought that, get away, go away. They did go away for a while. But from the standpoint of internal organization, the executive committee, I didn't care who was on the committee. And when the committee became loaded with non-portfolio managers, and to be, this is my personal opinion, younger millennials that were sensitive to criticism, sensitive to a certain style, that wanted a nicer tone
and you ignored that at your peril.
A slap on the back, and I ignored that at my peril. And so the executive committee became full of non-portfolio managers and younger millennials that when Bill Gross got mad at a meeting, they took it personally, whereas Bill Gross simply wanted to express his opinion. And so at some point, along with Allianz, I believe, don't really know, who I angered, I was going to say pissed off, but I angered the chairman one day. We came over to visit, and I told him to F off. And he looked at me and he said, "Bill," he goes, "no one has ever talked to me like that before." And I said, "Well, get used to it, dude." And that wasn't very encouraging from the standpoint of our relationship there. And so the executive committee in Allianz at some point said, this guy is got to go.
So the lesson therein is
to not to pack the executive committee or pack the Supreme Court, but to make sure you have some friends on it. I didn't have a single supporter on there, and so when somebody or some group of people got the notion that they wanted more money and they wanted more power, I was friendless from the standpoint of the exec, even though I was the bond king. Here's naive me. Who would think? Who fired the bond king? That can't happen, but it did. And that was my naivete, I think.
I have a pretty hard time imagining Bill Gross logging off his Bloomberg terminal for the last time. I always thought they were going to have to pry that keyboard from your cold fingers. The reality, of course, is that you may not be managing money for other people any longer, but you're going to continue managing money. What are you going to do after that door closes behind you here for the last time?
Well, I am going to manage my foundation's money, which is substantial. I always thought that my foundation could be as large as, or could rival some of the largest ones, and in Orange County it does. It's $500 million. So there's that, and then there's my personal money, and so there's lots to manage.
How will you run your family office? How will you invest your money?
Differently than others. I will strain to even have an assistant. I do it on my own. I've got a broker. Won't divulge, not necessarily to divulge the name, but I've been trading there for a long time. But do the same thing. I don't need 2 or 3 or 4 people to. I don't want 2 or 3 or 4 people. That's always been my problem.
So all the changes is that you don't get up in the middle of the night to check Germany and Japan?
That's it.
Seriously?
Yeah, I get up at 6:30 or 7 and stay with it for 2 or 3 hours, and then I hope, I go over to the golf course. Actually, here at Janus, not at PIMCO, because PIMCO's investment committees, thanks to me, I guess, droned on until 3 or 3:30 every day. We met for 2 or 3 hours a day, which were very productive, but so it didn't happen here. So at 1 o'clock, I would just walk across the street and play golf. So I'll just walk across the street a little earlier.
And get an 18 instead of 9.
Yeah, I hope. And it's only been 2 or 3 weeks, and who knows? I'm a type A type of personality, and at some point I may, want more or regret, just stepping out at the moment. But I think I'll be basically doing what I've been doing for the last 4 or 5 years.
People want to know what you'll be investing in. Are we talking about bonds? Are we talking about credit? Are we talking about stocks? Are we talking about futures? Are we talking about options?
Yeah, options and selling volatility through the sale of options, which hasn't worked too well in certain markets at Janus, but is a structural alpha-producing strategy if done at the right price. Do that, but mainly, my foundation doesn't need Amazon and doesn't need Apple, although my foundation wishes it had owned it. Okay.
Your foundation and a bunch of other people.
Yeah, but it's a conservatively run foundation. Same thing from the standpoint of personal wealth. Would I like to double it? I guess, but I'm realistic enough to know that it's not necessary and probably not going to happen. So I'm comfortable investing in closed-end funds and municipal closed-end funds at the right price, and other situations that have a certain minimum yield, and it's sort of old. Maybe
a little discount to NAV.
Oh yeah, for sure. Usually at 13 or 14% at the end of the year is your best chance. But so it'll be a little old schoolish, I guess, and conservative and boring. But that's the requirement, I think, at 74. And
what about your philanthropy? Where's that money going?
Oh, it's going to a lot of places. I've been. My foundation is now no longer the Gross Family Foundation. It's the William Gross, Jeff Gross, Jennifer Gross Foundation. So those are my 2 older kids, and they'll be the successors in terms of when I kick the bucket. And so we each have 3 votes, and we each every year submit requests and proposals and analyze those through the year. I have several people that assist in terms of field reports and so on. Nothing like the Gates in terms of activity, which I applaud, but that's just not me. But so we'll each have a joint focus. My daughter Jennifer is more focused on Africa and philanthropy there. She goes over to that continent 4 or 5 times a year and does a lot of groundwork and so on. So she'll do that. Jeff has, adopted the Children's Hospital of Orange County as a sponsorship, and so it'll go that way. And personally, for myself, I like to get it into the hands, directly in the hands of people that need it. The New York Times has New York's Neediest type of foundation where they find people that need money, and so I think for me that's a great way to do it, to use the New York Times and the staff that they have to get it into people. I also have a program called the Tipton program. It's named after John Beresford Tipton of an old TV program called The Millionaire, where he was the butler for a millionaire, and he would John Beresford Tipton would hand checks to people at the door, and they got out of their mind. So I have friends throughout the country that I tell them, I said, find people, through newspapers, through whatever, find people and talk to them, people that need money and that are worthy of the money. Send it to me, and I'll send them a Tipton check. I don't want to send them a gross check, because if you send them a gross check, then the whole neighborhood will be at my doorstep. So I got scouts throughout the country with Tipton checks going to people that need it for what? For rent, for a washing machine, for fix the car, for whatever. But so I love that, even though I never get to meet these people. I know that they're benefiting from this type of activity. So I'm more get it right to get it there. Whereas a Gates would be more long term. He wants to solve malaria. He wants, and wonderful. I'm just different.
Will there ever be another bond market king?
Now, if I said no, that's very presumptuous. It's just like Lady Gaga last night at the Oscars. I was just like, wow. But I think realistically, not in the same way, because like I talked about earlier, there aren't any vigilantes anymore, and James Carville probably wouldn't want to be reincarnated as the bond market, like is what he said.
That is what he said.
Yeah, those days have gone. Carville wouldn't say that today. He wouldn't want to be the bond market today. And so, would there be another bond king? Probably not in the same way, because to be a king, you have to have a kingdom. I think the term partially went with the fact that PIMCO got to be $2 trillion. That was a kingdom. But PIMCO was...
certainly relative to the size of the market.
Well, for sure. And relative to the size of... I was always so amazed. I couldn't convince myself. I'd walk on the weekends and I'd go, my God. I go, 2 trillion. I go, it's bigger than Bank of America, than Goldman Sachs, and JP Morgan. I said, what? I go, we're almost the biggest institution in the world, aside from some Japanese banks or whatever. I go, how did this happen? I go, but it did. And that was a kingdom. And so I would think you've got to have a kingdom, and I don't know if that's really possible anymore, other than indexed funds, of which, if you are the king, you're just a puppet, because the market's making a decision. So probably not. But there are still experts in the bond market. I especially like Scott Menard. I think
at Guggenheim.
Yeah, I think in the right environment 20 years ago, he could have been a bond king. He's got a great long-term perspective, but I don't think he's got the market or maybe the willingness to be a king. There are some that, remember that song, Who Would Want to Be King? Who would? Well, I guess I did, but in retrospect, it carries a certain burden. The crown is heavy.
He who wears the crown, yes. Are there any other pretenders, let's call them, to the throne that that you admire, that you're watching, whose careers you think hold particular promise?
Oh, I don't think so. I don't necessarily have a prejudice against Jeff Gundlach, but I don't know. I think I guess I'd stick with Scott Menard if there was. I mean, how many kings can there be?
Well, in any one kingdom, only one.
Yeah, that's right. But it's been. It was something. When I first started out, my parents came down here in 1974. I think I told you this once. I'll tell it again. They came down, and I'd just gotten a job at Pacific Mutual, the building right across the street here. And PIMCO was just starting, and they came down. They said, "So, Bill," they go, "So what are you doing?" I said, "I'm trying to put together this company to manage bonds." And of course, I didn't even know what a bond was. And they said, "Well, so where does that take you?" I go, "Mom," and I guess I just said Mom, but Dad was there too. I said, "Mom, I'm going to be the best portfolio manager in the world." And they looked at me like I was from Mars. No comment whatsoever. Partially because
Stunned silence.
They didn't understand it. And secondly, because of the temerity to suggest. But somehow I knew that was my goal. I didn't know what was going to happen, but that was my goal. And for the most part, at a certain time, I was the best bond manager in the world. And like I say, what am I most proud of? Well, having done that, created a lot of benefits for a lot of people, not just investors, but people in the local neighborhood and people everywhere in terms of jobs and so on. And they come back and they say, you made my career, you made my marriage, you made me. And I go, I did? Because I sort of forget what was it like, I guess. But so there's a lot of people that I'm happy for, and that I think are happy for me.
So Burden's considered better to have been king than not to have been king at all.
Oh yeah, that's what I wanted to be. There's no denying that that's what I wanted, and in part it came true, and so good for me. And just to add as an aside, I think personally I didn't give up much from the standpoint of family and from the standpoint of relationships. I mean, I went home at 4:30 every afternoon. There was time for kids. There was time for all of the soccer, the hockey, the going around the country. I was a good dad and a good husband, and I think I succeeded there almost as well as I did at PIMCO. And so I probably like myself more from that respect than even, having been the Bond King.
Well, here's to living a full life.
Thank you. Thank you.
Thank you, Bill.